Starbucks is collapsing now. They're closing 500 stores, spending $1 billion. And I'm about to show you the one hidden reason in their financials that proves this crisis is much worse than they admit. From Wall Street to your wallet, this is smart money sense. Your daily coffee run is about to change forever. You've seen the headlines, you know the story, or you think you do. Starbucks, the undisputed king of coffee, is closing hundreds of stores. They're laying off nearly 1,000 corporate employees. They're spending $1 billion to shrink. But the headlines don't tell you the whole story. They tell you what is happening, but not why. This isn't just a simple course correction. This is a symptom of a much deeper problem. We're witnessing the Starbucks financial crisis of 2025, and it's a warning sign for the entire retail industry. If you want to understand the real story behind the numbers, you're in the right place. Stick with me, because by the end of this video, you will not only understand why Starbucks is in trouble, but also what it means for your wallet, whether you're a customer, an employee, or an investor. Let's get into it. On September 25th, 2025, Starbucks CEO Brian Niccol dropped a bombshell. The company announced a $1 billion restructuring plan. Let's write that out. $1 billion. What does that buy you? Well, in this case, it buys you less. The plan involves closing approximately 400 to 500 underperforming stores across North America. That's about 1% of their entire North American fleet gone, just like that. This follows a trend as the company already shuttered hundreds of locations in 2020. On top of that, 900 corporate jobs are being eliminated. This is the second major round of layoffs this year after 1,100 jobs were cut back in February. So, in less than a year, 2,000 corporate employees are out. The company is framing this as a strategic reset, a back to Starbucks initiative. But when a company spends $1 billion to get smaller, you have to ask the hard question: is this a strategic pivot or a desperate act of survival? To answer that, we have to look at the numbers they'd rather you not see. The story of the Starbucks financial crisis of 2025 isn't written in memos. It's written in financial statements. For 6 consecutive quarters, that's a year and a half, Starbucks has reported declining same-store sales. Let me put that in perspective. Imagine owning a shop, and for 18 straight months, the average customer who walks in spends less than they did before. It's a slow bleed. In the most recent quarter, global same-store sales fell by 2%. But here's the really scary number. In North America, their most important market, customer traffic, the actual number of people walking in the door dropped by 4%. People are actively choosing to go elsewhere. And it gets worse. This is the hidden reason I mentioned at the start. Look at their profitability. A company's operating margin is a key health indicator. It's the profit they make on each dollar of sales before taxes. In late 2023, Starbucks had a healthy operating margin of over 18%. Fast forward to today, and it has cratered to just under 10%. It's been cut nearly in half. This is a 5-alarm fire in their finance department. Costs are up, sales are down, and profits are evaporating. This is the financial storm that is forcing the company to make these drastic cuts. And if you're finding this deep dive into the numbers valuable, do me a favor and hit that like button. It tells the YouTube algorithm that we're delivering real financial sense, and it helps our small channel reach more people like you. Thank you for that. Now, where are those customers going? For decades, Starbucks had no real national rival. They were the default. That era is over. The coffee market has become a battlefield, and Starbucks is getting flanked from 2 sides. On one side, you have the value players. Luckin Coffee, once a disgraced company, has made a monster comeback in China with over 20,000 locations, and it's expanding. Their model is simple: good coffee, fast, and about half the price of Starbucks. They are relentlessly stealing market share. On the other side, you have brands that are mastering convenience and culture like Dutch Brothers. Concentrated in the Western US, their drive-thru heavy model is incredibly efficient, and they've built a fanatical following. They are what Starbucks used to be: cool, fast, and a little bit rebellious. A recent UBS survey revealed that over 70% of people visiting Starbucks less often cited one simple reason: it's too expensive. In an economy where every dollar counts, paying $7 for a latte is a luxury many are cutting back on. Starbucks is stuck in the middle, too pricey for the budget-conscious and no longer the coolest option for trendsetters. This is a classic strategic trap. While Starbucks is fighting a war outside its doors, it's also fighting one within. The rise of Starbucks Workers United has been a major storyline. Over 12,000 baristas across more than 650 stores are now unionized, demanding better pay, staffing, and working conditions. The union's reaction to the closures was swift and angry. They said, and I quote, "This announcement clearly indicates that under Brian Niccol's leadership, things are regressing at Starbucks. Once again, we find ourselves facing new policies and significant decisions made without any input from baristas. This creates a massive headache for the company. How do you implement a top-down back to Starbucks vision when your frontline workers feel ignored and disrespected?" The closure of unionized flagship stores like the iconic Seattle Reserve Roastery has only added fuel to the fire, with many seeing it as a form of union busting, although the company denies this. This internal conflict drains resources, creates negative press, and complicates every single move the CEO tries to make. So what is CEO Brian Niccol's grand plan to solve this Starbucks financial crisis of 2025? He calls it Back to Starbucks. Niccol is a turnaround artist, famous for reviving Chipotle after its health scares. His playbook is about getting back to basics. The strategy has two main parts. First, the cuts we've discussed, closing unprofitable stores and slashing corporate overhead to stop the financial bleeding. But the second part is reinvestment. He's taking the money saved and pouring it back into the remaining stores. The plan is to spend over $500 million on more labor hours so your drink is ready faster. They are remodeling over 1,000 stores to be cozier, with more seating and power outlets, trying to bring back the third place feel. They're even bringing back ceramic mugs and free refills on basic coffee and tea for customers who stay in. It's a massive gamble. Niccol is betting that a better in-store experience will be enough to convince customers that Starbucks is worth the premium price again. He believes he can make Starbucks feel special, not just transactional. We've covered the crisis and the plan, but what does the future hold? Before we get to my final take, if you're new here and you believe in making finance make sense, hit that subscribe button and join the Smart Money Sense community. We have just over 200 subscribers now, and every single one of you makes a huge difference. Let's grow this together. Now, for the $1 billion question. What does this mean for investors? The market's reaction to the news was a shrug. The stock, SBUX, barely moved, and it's been down over 7% this year. Wall Street analysts are divided. About half have buy ratings with an average price target suggesting a 17% upside from here. They believe in Brian Niccol's track record and think the plan will work eventually. The other half are skeptical. They see a company with a high valuation, trading at a price-to-earnings ratio of 36, which is expensive, but with deteriorating fundamentals. They argue that the core problem of being too expensive in a competitive market hasn't been solved. The turnaround is expected to take time. Management themselves don't expect to see significant results until fiscal 2026. This means investors today are being asked to pay a premium price for a maybe. They are buying the story, not the current results. It's a high-risk, potentially high-reward bet on one man's ability to turn a giant ship around in a storm. So, what does this all mean for you? If you're a Starbucks customer, expect a tale of two cities. Some stores will close, maybe even your local one. But the ones that remain are supposed to get better, with faster service and a more welcoming vibe. The question is, will it be enough to justify the price? If you're an employee, the future is uncertain. While the company is adding barista hours, the corporate layoffs and store closures create a climate of instability. The Starbucks financial crisis of 2025 is a fascinating case study. It's about more than just coffee. It's about brand decay, the perils of being a premium brand in a tough economy, and the challenge of reinventing a legacy company. Starbucks is at a crossroads. The path they've chosen is costly and risky. The next 12 to 18 months will determine if this $1 billion gamble pays off, or if the coffee giant's best days are truly behind it. You've just gotten one step smarter. To keep building your financial sense, watch this video next. And subscribe so you never miss an insight. This is Smart Money Sense.